What do the candlesticks have to say about today's major moves in the stock market? Was the selling climax over yesterday? Are we headed for more upside? Or should you be prepared for a bounce back? All of these questions will be answered in this short video, just under 3 minutes. Here's what the candlestick has to say about today's market moves. So without any further ado, let's get straight into it. Let's start with the S&P 500. We see that today's candlestick looks like this. We had gains in the first few hours of trading before seeing those gains completely reversed, and then some with increased selling coming in as the clock winds down. This type of candlestick is a classic example of a bearish reversal pattern, where aggressive buyers early in the session fail to hold on to their gains. Instead, they reverse course and end up closing the day worse off than if they had simply not traded the stock. This is because the buyers who entered at the open lacked conviction in their bullish thesis, entering as the price gapped higher, but failed to stick around through the choppy and sideways action that ensued. And this is the difference between being a passive bystander versus an active participant in the market. This chart alone isn't enough to make any sort of price prediction. But when combined with the mess of events that took place yesterday, this single candle tells us all we need to know. A lack of conviction from buyers, a re-emergence of sellers, and the potential for a bounce back or retest of sorts. Given the past few weeks of choppy trading amid inflation news and mixed earnings, this reversal candle doesn't come as a surprise. As mentioned in previous reports, this exact scenario was a real possibility. If the market was unable to gain follow-through buying interest during today's session, this type of pattern often hints at the beginning of a pullback or further consolidation before the next leg higher. It also signals that the sellers have regained short-term control after the buyers dominated last week. However, it's important to note that this doesn't mean an instant reversal will take place. Instead, it indicates that the path of least resistance has shifted to the downside, and the odds are now in the seller's favor. If we zoom out to a larger time frame, we can see that we have been in a trend channel since late August. Prices have oscillated within this range and seem to be following a well-defined path of most resistance and most support. Each time price tries to break this range, either to the upside or to the downside, it ends up reversing direction and returning to the middle ground. This would suggest that the market is still indecisive about its next move, and that both bulls and bears are still fighting for control. As it stands, this candle and the events that preceded it tell us that the bulls have lost steam for the time being. They were unable to push prices higher and instead saw the market close at the low of the day. This often serves as a warning sign for the coming days. If tomorrow brings similar levels of uncertainty, it's entirely possible that the S&P 500 could fall victim to a more significant correction. For now, it's safe to say that the market is likely to continue consolidating until a clear direction is established. Moving on, let's examine the Dow Jones Industrial Average. Today's candlestick looks much different than the one on the S&P 500. We see yet another bearish candle closing below key support levels. This is a continuation of the prior day's bearish price action, signaling sustained downward momentum and a lack of interest in moving prices higher. What makes this candle particularly worrisome is its resemblance to the previous two candles, which were also strong bearish candles with minimal lower wick. This persistent downward trend, coupled with a lack of buying interest, suggests mounting selling pressure and a greater likelihood of a short-term correction. To make matters worse, the Dow closed below its 200-day moving average, breaking crucial support levels. This adds even more weight to the argument that the market is currently in a state of shock and is still processing the implications of new tariffs and persistent inflation anxieties. As long as the Dow remains stuck below this line, it won't be able to regain any upward momentum. Instead, we could see the index fall further in the coming days. Finally, let us look at the candlestick for the Nasdaq 100. Today's candle is much more reassuring compared to the previous two indices. The index closed with a modest, bullish candle at a new record high. This signal represents a slight victory for the bulls, showing that the buying pressure is still present and that mega-cap and tech stocks remain in demand. While the candle is bullish, it does feature an upper wick, suggesting late-session profit-taking. No outright bearish reversal emerged, providing some confidence in the prevailing uptrend. It's worth noting, though, that the Nasdaq's largest gainers of the day, Nvidia and Microsoft, saw their shares rise on positive news, while the rest of the index saw marginal growth or slight declines, nevertheless, with no clear bearish reversal yet confirmed. It seems that the Nasdaq's bull momentum is set to persist in the short term. Here's a quick summary table showing the candle signal and what each index is trying to tell us. So the S&P 500 gave us a bearish reversal signal telling us that there is a risk of a correction in the coming days and that the sellers are starting to gain back control over the buyers. The Dow Jones gave us a strong bearish signal, telling us that there is ongoing weakness in the market and that we should keep an eye on the support level. Finally, the Nasdaq gave us a bullish signal, telling us that there is no immediate warning signs of a reversal and that the uptrend is still intact. So now you might be wondering, what does all of this mean for me as a trader or investor? Well, to answer that question, let's briefly recap what we covered earlier. We saw that the S&P 500 and the Dow Jones closed the day with bearish candlesticks, reflecting broad market unease. This suggests that investors are becoming increasingly cautious about the near-term outlook. Moreover, the structure of these candlesticks, with their lack of lower wicks, indicates limited interest in buying the dip. This could be attributed to uncertainty surrounding economic data, such as CPI figures, mixed earnings reports, and concerns over new tariffs. Such defensive price action often emerges during periods of heightened anxiety and volatile trading conditions. Conversely, the Nasdaq closed with a positive daily formation, showcasing relative strength among mega-cap and tech stocks. Despite featuring an upper wick, which hints at late session profit-taking, the index still managed to close at a new record high. This resilience can be seen as a positive sign, as it suggests that investors remain optimistic about the growth prospects in the technology sector. So overall, what does this tell us about today's trading activity? First and foremost, it's evident that the majority of market participants are currently adopting a wait-and-see approach. This cautious sentiment is fueled by uncertainties stemming from various factors, such as the latest inflation data, mixed earnings reports, and lingering anxieties over new trade policies. Secondly, today's price action reveals a clear preference for defensive plays, particularly among growth-oriented investors. With limited appetite for risk and a desire to preserve capital, many are choosing to stay on the sidelines or reduce their exposure to potentially volatile assets. Thirdly, despite the overall subdued sentiment, the technology sector continues to attract interest, as evidenced by the robust performance of the Nasdaq. This suggests that investors remain optimistic about the long-term growth prospects in this space and are willing to overlook short-term challenges. As we move forward, it's essential to recognize that today's candlestick analysis only provides a snapshot of current market conditions and is not a guarantee of future performance. While it does offer valuable insights, it should be considered alongside other technical and fundamental indicators. For those looking to capitalize on short-term opportunities, adopting a nimble and adaptable strategy can prove beneficial. Keeping a close eye on key support and resistance levels, as well as monitoring geopolitical developments and economic releases, will be crucial. However, it's equally important to remain vigilant against potential risks and avoid making impulsive decisions solely based on candlestick patterns. In conclusion, today's candlestick analysis paints a mixed picture of the current market sentiment. While there are signs of caution and the potential for a correction in the broad benchmarks, technology continues to show resilience and upward momentum. Investors must remain adaptable and prepared for more volatility in the days ahead. Thank you for watching. If you enjoyed this video, please leave a comment, like, and subscribe. Thank you for your time.